Hi and welcome everyone. Thank you so much to ETHMilan for organizing this awesome panel. Today's topic is a little bit spicy. We're going to talk about derivatives. So I want you to think about what questions you may have in the end, because these guys around me are experts on the topic and you want to hear firsthand from them. Now, we have quite an exciting panel. We have Dan, Darren, Mathieu, and Bearlusconi. And just for the purposes of booping the bear, I have booped the bear, so if you want to see him afterwards to talk about Berachain. Let's start with a little bit of an introduction. I'll pass the mic around. I would love for you guys to say who you are, what you do, and what your project is. Let's start with Darren.
Hi guys, my name is Darren Camas. I'm the co-founder of Ipor Labs, which builds the Ipor protocol. This is my 13th year in crypto, so in crypto years I should be dead. So the Ipor protocol sits on the credit market side of the derivative space. It's very different from the perps, which kind of dominate the industry. You can think of the interest rate derivatives market as the most important market that very few people know about. So, for example, if you've ever taken a fixed rate mortgage, then you've dealt with interest rate derivatives, but you're not trading it. It's the underlying piece that creates these instruments. It's the market that the lack of interest rate hedging led to the death of Silvergate Bank, Silicon Valley Bank. 3 years ago, it almost bankrupted the UK pension system, but very few people know about it. Again, it's the underlying of the global financial system. So Ipor protocol is very much into the interest rate derivative space.
Thanks, Darren. Hi all, my name is Dan. I'm one of the co-founders of Rysk Finance. Rysk Finance is a DeFi options protocol. That's how it started actually a couple of years ago. And now it's more into derivatives. So what we're focusing on now is basically providing liquidity for derivatives, not just options. And most important, we also have an exchange as well, which is an order book, low latency type of exchange. So my main focus as Darren is basically been in derivatives in the last couple of years. And derivatives, I think, is even faster in terms of years when you are in crypto. I guess like the curve is even higher. So a couple of years into derivative space in DeFi, it's basically like, probably I'm already dead.
Your hair's graying out, falling out. You're into derivative space for like 2 weeks.
So everyone, do you hear me? I guess, maybe. I don't know. Let's try. Let's give it a try. So I'm Bearlusconi. I'm in crypto since 2017, something like that, so I'm younger. You know, I'm still young. I'm also a bear, so maybe I live more, I don't know, maybe less, we will see. But yeah, I started working in crypto, like doing blockchain, it was at the time, not really DeFi. Then DeFi came out, DeFi summer. Actually, we was also to play with privacy during DeFi summer, so COVID was a fun time for me. And then after that, we said with my team, okay, let's do purely decentralized stuff because we are more into the institutional stuff. And we said, okay, let's learn something cool. We work on concept of on-chain liquidity, DEXs. And we built Smiley Finance, a derivative protocol on top of DEX liquidity. And then now I'm doing product at Berachain, so I'm here to ship a proof of liquidity to the world, guys. Be ready.
Thank you, Bearlusconi. Hey everyone, I'm Mathieu. I'm a co-founder at InfinityPools. I guess we all started with you know, how long we were in crypto. So freshman year of college, I was in New York, and I was mining Bitcoin back in 2014, something like that. I'm dating myself, but yeah. Yeah, so also been in the industry a while. InfinityPools, I'll keep it short and sweet, is a new exchange purpose-built for a completely new financial instrument we invented that allows for unlimited leverage on any asset with no liquidations, no counterparty risk, and no oracles.
Cool, let me see. Okay, perfect. You can just keep that mic on your end.
Cool.
Okay, let's dive right in. So the first question is, let's talk about perps, the elephant in the room. What are perpetual futures in the crypto derivatives market, and how do they manage to replicate future contracts without an expiration date? Shall we start in order?
You want me to do it?
Yeah, go ahead.
Okay, I can do it because one of the products that we offer is also perpetual, so I have a bit of understanding. Perpetual futures, like a bit of history around it, they actually started with crypto mostly. It was an idea of our friend Arthur Reyes at BMX. One of the main concepts was basically to try to recreate a product which was basically giving leverage to the user, so you can potentially do up to 100x right now. And the idea was to basically don't have an expiry date, so that's why it's a pair future. The mechanism around the pair future is fairly straightforward. You basically, let's say you have an asset which the price is like 10,000. If the future is pricing differently from this asset, let's say 10,000, it's a bit above or behind or below that, there is a funding rate which is like kind of a fee that basically you paying to make sure that you're paying the other side of the trade to make sure that the price converge to this. So in this way you can have an instrument which is perpetual, and there is one side, let's say the people that they're long or people that they're short, that basically paying the other side to have that position and to try to put the price back to what should be the fair price of the specific asset. In crypto right now, only in DeFi, the volumes of this asset is pretty, like it's over 100 billion in only talking about DeFi space. And to give you a number, when you compare that to something like options are not even a couple of billion. So it's completely different beast right now. And they became very popular, especially with FTX as well. I think FTX was probably one of the things that made those instruments extremely popular. And we all know what happened to FTX, but actually that was also like a big catalyst for actually DeFi futures to even get better. So now we have, platform like Hyperliquid, DYDX, and so on, which are like definitely like the growth in the last couple of years was massive. So that's the kind of instrument that everyone is trading right now in crypto and in DeFi when they want to get derivatives. I don't know if Mathieu wants to add something because at the end you have similar of a pair, right? Yeah. But better.
Way better.
Way better.
We have a way better pair. No, we will see. Still cooking. But yeah, so to me, the cool stuff about pairs that I would like to highlight when it comes to crypto is that there is a lot of, so he hinted at Hyperliquid, potentially order book models, or this kind of assets, of this kind of exchange type. What I like a lot actually is on-chain liquidity. So in crypto we saw many times, like with DEXs first, lending market and borrowing protocols, and so on and so forth, that we can bring on-chain liquidity, create new stuff that maybe we didn't see in TradFi. And that's actually the angle I like the most. And so actually when it comes to pairs as well, that's something we can, something cool out there. That sometimes we have vaults with liquidity, and the vaults, okay, right now maybe they're still in, we are improving them, but once we will have them done very well, we have this super liquid market, new stuff you can build on top. Like for instance, coming to Smiley Finance, my previous experience, we built, Italy wanted to build options. We ended up with a product that was kind of in between, had some similarities to pairs, some similarity to options. And putting them all together was actually super fun, but at the same time, pretty innovative. We didn't expect at the beginning to end up with that, and I mean, this is the magic of DeFi. So it's a space that we will be building new and new stuff over and over. I don't know, Mathieu, if you want to add, because actually your product is even more, fitting this narrative. So.
Okay, yeah, I can add a couple things. I actually think that perps actually do have an expiry. Most people don't actually realize it. They're actually 24-hour futures that get rolled over and get settled via the funding rate. So they feel like they don't have an expiry, but they actually do expire every 24 hours, technically speaking, which are actually a really interesting property of the instrument. And the way it works is that the longs are borrowing from the shorts, and the shorts are borrowing from the longs. And that's how the funding rate is determined. But beyond technical comments on the structure of perps, I'm not sure I'm going to add much at this point. So.
Yeah, let's pass it over to Darren.
So if we take like a short journey back in crypto and why perps are so popular, and it's actually because the crypto ecosystem and the trading ecosystem is extremely mature. So perps existed before, but they were really popularized first by BitMEX. And so BitMEX was one of the pioneers in the space. They also pioneered the troll box, which is, you know, the little chat window where people say very nice things to one another. Bring back the troll box. And one of the things about the troll box is that a lot of the traders on BitMEX, you know, BitMEX, they were doing dated futures for Bitcoin, Bitcoin to Bitcoin, priced in Bitcoin dated futures. And you had a bunch of traders in the chat box which were calling scam when the contracts expired because they didn't understand how to trade futures. And instead of looking at this and thinking, you know, the BitMEX team, Arthur, Ben, Sam, they were looking at each other, different Sam. They were looking at each other and saying, you know, basically like, okay, should we force the traders into learning about dated futures, or should we adapt to the traders? And so they effectively created this perpetual mechanism that's extremely popular because the traders didn't know what they were doing. So it's quite interesting, but that also tells you a lot about the types of people who were trading very early, also the types of people that are trading right now. So perps are a great speculation mechanism. They're very interesting, very exciting, but it's also very difficult for market structure if you're trying to do something like, the whole idea of dated futures is that you can hedge on a time horizon and you have, for example, your cost to hedge locked in. But on a perp, it's variable. So it's very great for speculation, but it's not very great for market structure. However, you know, the product market fit shows that we're basically extremely degenerate on the speculation side, but maybe not paying much attention to the market structure.
Actually, speaking of BitMEX, there's another interesting fact that I think most of the you know, like late joiners in crypto don't know, but one of the reasons that it was actually so popular is because they settled all of their trades and collateralized all their trades in BTC rather than USD. And essentially, that was their way of getting around AML, KYC. And so essentially, they were a custodial exchange with no AML, KYC, which obviously later landed their founder in some hot water. He never actually went to prison. No, he was under house arrest. Yeah, so, you know, and the guy's a billionaire, so is it worth it? I don't know. But yeah, so one of the main reasons it was really popular is because it was essentially a derivatives exchange that was custodial with no AML KYC. I will say that, yeah, trading with BTC as collateral was quite complicated because it had a payoff that was very, very different from what most people like generally think of in terms of you know, derivatives payoffs. It wasn't linear, but yeah, as an early BitMEX trader, I got liquidated a bunch of times. Probably funded some of Arthur Hayes' current lifestyle. So cheers to that guy.
That's so interesting to get this perspective on. You have all been in the space for such a long time. And again, like Darren said, like being in crypto for so many years is like a couple of lifetimes. And it's really interesting to get the insider perspective of what actually went down. Now, a question for the audience, just so we're aware, who here considers themselves a DJ? And hand up, don't be shy. Yeah? Okay, good. That's what we want to see. The thing is,
Fed question. She's
yes.
sending the IRS after every one of you that raised their hands.
We won't tell, don't worry. Who got liquidated recently? Anyone got liquidated recently? Oh.
Only few real DJs.
So we've talked about perps a bit. If you have questions about perps, we can definitely talk about that later on. But what are some other financial instruments that you are bullish on beyond the conversation about perpetuals? And I know, Darren, you've got an opinion on this. What are you bullish on?
So Ipor naturally is bullish on fixed income in DeFi. So if you think that, you know, most crypto traders are trading assets, They're trading speculation. So when we were looking at building Ipor in the first place, we were looking at the structure of the crypto markets. We were looking at the TVL split pretty nicely, half and half between DEX and credit markets, right? We knew that the race to become the decentralized BitMEX or FTX or Binance perps is going to be a tough one. It's going to be a very lucrative one, but it's going to be a red ocean, you know, a bunch of sharks tearing each other apart. And in crypto, in centralized exchanges and decentralized exchanges, it's very hard to stay on top. Everyone cannibalizes one another. But we were looking at the credit market side and saying, okay, so this really is important. So, you know, if we take that idea of getting a mortgage on chain, a fixed rate mortgage from a DeFi protocol, you know, how does that become a reality, right? If you're trading perps, great, you're looking for some kind of speculation, but I would say that DeFi has really failed if we actually can't get to this point where we can do something like a car loan or a home loan with some fixed rate from an on-chain protocol. Otherwise, we're just thinking very short term, and it really has no real utility, especially in, you know, the physical world if you want to buy an asset. And I mean, that's most people's use case. This is the utility for the rest of the world. While the DeFi natives might be happy, you know, seeing a number go up and down on chain, most people, they need to drive a car, they need to live in a house. So we were looking at the interest rate derivative space and seeing that it's probably the most unexplored space. It's the one that has the highest upside, the highest potential market cap of any derivative market in DeFi. And no one's really looking at it. And if we look at something like crypto is enamored with rates, you know, like every time J-Powell gets on the mic, everyone is going crazy to see, you know, are we hawkish, are we dovish, what's happening, right? So everyone in crypto pays attention to rates, but no one pays attention to rates in crypto. But again, you know, it's a $650 trillion market in traditional finance. Second largest market in the world is the interest rate derivatives market. So that's really why we started building Ipor. You know, and if you think of a long history in crypto, my interest isn't looking to build something that's speculative, flash in the pan, goes away overnight. We were really looking at something that can build structure in the markets and utility not only for crypto natives, crypto degens, speculators, but the average person in DeFi. So interest rate swaps, they're a widely used instrument. They're quite vanilla. And you know, if you're quite degen, on the interest rate swaps on Ipor app right now, you can get up to 1,000x leverage. And if you're trading perps, you look at that and you say, that's ridiculously degenerate. But an interest rate swap is very different. It's an exchange of cash flows over time. So you're trading some sort of exposure to the interest rates. So for example, if you choose to pay fixed, that means if the rate goes up, you're profitable on the swap. So the whole idea is, let's say you borrow from Aave, you borrow from Compound, you borrow from Morpho, and you take a pay fixed swap, that effectively creates a fixed rate borrow. And that's quite useful to the average person. And so the idea of 1,000x leverage there isn't degenerate, it's actually extremely capital efficient. You don't want to hedge your interest rate risk with the entire notional. So you are actually creating this nice fixed income instrument. But if we go back to the product market fit of perps, the average person doesn't have the specialty to actually trade not only dated futures, but interest rate swaps on chain. So this is one of the barriers that has been for Ipor to introduce the world to interest rate swaps. However, one of our new products, Ipor Fusion, it's a composable asset management suite, and it actually can be used to compose structured products. So for example, if you take something like leverage looping, what's leverage looping? You borrow Ethereum, you will get staked Ethereum, you have some borrowing cost on the ETH, you have some return on the staked ETH, and you're really trying to farm that basis with leverage. If you want to build a nice structured product on that, you can also take an interest rate swap on the ETH borrow, a stake rate swap on the ETH staking rate, and create basically a fixed return over time, and this is a very nice instrument. Right now, we're also at a time where we have institutions coming in. So not only do we have the ETFs for Bitcoin, we have the ETFs for Ethereum, we also have BlackRock, which is tokenizing the what is it, Build fund? Which is, it's a fixed income fund. It's bringing RWAs or treasuries and bonds on chain. And so this is a very fixed income product. And BlackRock and the types of users, they're not going to be speculating on perps, on assets. What they're trying to do is they're trying to return cash on cash. So I think the fixed income market is the biggest opportunity inside of crypto. And this is why we focus on interest rate derivatives.
Wow, dare I say this sounds healthy. This actually sounds quite good. And I'm wondering, Dan, do you have a perspective on, on what you're bullish on in terms of risk capital and where you stand?
Sure. When it comes to what I'm bullish on, I would say I'm bullish on everything that's going to bring liquidity into this space. I think the main issue that we have as of today, especially when it comes crypto in general, DeFi even more, is like we don't have new liquidity in. It's like most of the things that are happening is just like liquidity moving around between the actors inside of it. Perps are a great instrument. As of now, they're a commodity. Like there is not a major innovation. Most of them is just like, slightly small innovation there happening, but users moving around from an exchange to the other. There is no real, probably like the reason why you're on exchange is mostly like you get attached to it in terms of community, but like in terms of product, they're pretty much all the same. Liquidity is there for most of the trades. I have to agree with Darren, like when it comes to bring new liquidity into the space, in the last year, I think we had a major breakthrough, which is we finally see institutionals. We have ETF on Bitcoin, ETF on ETH, probably it's coming on Solana. A few days ago, we saw one of the first announcements about the first structured product on top of options. So when I have to think about what is this, what I'm bullish on is making this space more friendly for not just casino people, which I think they already found product market fit. They're already having a lot of fun into the space, getting liquidated and so on. So I think everything there, and that's kind of like the direction that we're thinking as well, is the space is getting more mature. Like a couple of years ago, the exchange in terms of like quality of the exchange, in terms of liquidity, that we're not even close to where we are today. I think we saw like a lot of development in the last like 2 to 3 years. And now what we need is like new liquidity. And even the approach that we're taking at Rysk right now is like we are about to launch this new product, Rysk V2, which is still an exchange for pretty much derivatives in general, but what is actually a breakthrough is like how we bring liquidity in. We're basically making market making, which is usually an activity which is high sophisticated, like only few actors like are able to do it. As an average user, there is no way that you can access to this type of like high frequency market making strategies. And that's what we basically enable people to do. Like they can deposit into one of those strategies, basically having access. So even in this way, we are getting more of like passive appetite from users that can participate into this market without knowing what, they don't even know what is a perp contract. They're just gonna deposit and basically they're doing high frequency sophisticated strategies. So that's kind of like the direction that we're taking. It's like on the exchange side, probably refocusing on the option, because we were doing options a couple of years ago and it was extremely challenging. The market wasn't there at all. The product wasn't probably the best, but like many ever tried, and I think no one still figured it out, like how to solve this options problem. But as Darren said, like when you want to build more sophisticated structured products, more institutionalized product, most likely you're not gonna build it on top of a perp with 100x leverage. It's probably gonna be more options, more sophisticated instruments. So I think that's the direction that I'm bullish on. Or at least that's the kind of hope that I have into this space. Because again, right now it's a great space for the casino, for the meme coin, for the perps and everything, which is fine. I'm one of those, users there, but like I think if we want to grow the entire industry, we need something like that.
I think that's a really great take. And again, we do love going to the casino, don't we all? But at some point, we do mature and we want to have some strategies in place that we can actually understand, feel comfortable with, and that will build onto our future. So I really love both of your takes. And what about you, Bearlusconi? Do you have a take? What are you, I want to say bullish, but then again, you're a bear?
I'm bear, up only actually. So I totally agree. With the answer so far. Obviously, bringing institutional money in is the core. Becoming the TradFi of tomorrow is the core. There are a couple of stuff I really like, actually, and so I ended up always thinking about there, that is related to composability, openness of this technology. This is, I think, really something amazing. That's what I generally spend my nights brainstorming about with a couple of friends here in the audience. And so on one side, the thing that for me is super cool is building, it's money legal, building on top of other stuff. I think DeFi has experimented that just a little, realized it was super amazing. Then due to technical stuff, ourselves builders sometimes using standard not super fitting, we stopped doing that, or at least we did that less. And obviously, if you take them out, you go back to the story when I started, it was like, oh, cool technology, let's put it into the standard processes. No, that's not innovation. We don't care about that. We want to change the stuff, build new stuff. And I think even starting from perps, we have some ideas out there, like you can build a perp using, or let's say option. Okay, option is even easier for me. We built option out of DEX liquidity. We take DEX liquidity and we said, you can build an option out of that. So with that liquidity, you can have a swap and an option, both at the same time. So, it's incredible. It's way more efficient. You can do way more stuff. But that's just the beginning. That's what we experimented as Smiley, and it was fun. But like with liquidity on chain, with proof of liquidity potentially, but that's another topic, you can build really huge stuff. And I think in the next couple of years, more and more we will see that. That's one side. The other side of the story is that the openness of the technology allows you to build new stuff also at the product UX level. Like, let's take perps. Okay, we talked about perps, amazing, a lot of stuff. I mean, this year, or last year it was actually, but I mean, people built a stable coin out of a perp, basically, ETHMilan. They basically said, okay, I can actually fund the rate, short there, take that, build a stable coin out of that. At the beginning, everyone was like, oh, maybe this is Terra Luna again. Actually, I mean, we studied a bit and we were like, actually, this is not. But I mean, this is an incredible innovation. Like, people are basically participating in the perp market without knowing because they are simply using a stable coin that is a currency. This is brand new, this is new stuff. Maybe because I was in Deutschland, so we like the magic investment banking money. At the time, we called that way, but these kind of things, I think we shall really dig into that and find a way to make DeFi 10 times, 100 times, even more so, 1,000 times better than TradFi. This is my two take, yeah.
Matt?
Yeah, I mean, first of all, I completely agree that, DeFi definitely unlocks greater composability when it comes to financial instruments, and it's one of the main reasons that I'm very, very bullish on it. Like, even our instrument is very composable with the rest of DeFi. Actually, Dan said something earlier about options being a little more composable than perps that I actually completely agree with. One of the things that led us to building our current project, I actually didn't know if you knew this, but before we built InfinityPools, we spent a few months building something called lemma.finance. Yeah.
That's how we met.
Yeah. Lemma.finance was essentially Ethena, but decentralized. So basically, it was all smart contracts building on top of perp dexes. And one of the things that we noticed building on top of perp dexes was that it was terrible. It's just terrible. It's so many risks, so many whatever. Options are actually like quite a bit better. But it is true that even just that by itself is a huge step, right? Like, you would never be able to build a stable coin on top of, whatever, like CME futures. That. And then actually one thing that you said, Bearlusconi, is, which is something that both Smiley and InfinityPools are kind of working on right now, is that, we are inventing completely new financial instruments that I'm actually very surprised we haven't seen in traditional finance. So, for example, the fact that you can create options out of loans of spot liquidity, right? So, super simple way to think about it. Let's say you've got an order book, price of Ethereum is $1,000. You've got a limit order at $900, right? Spot limit order at $900. If a trader borrows this spot limit order at $900 for 24 hours, what does that mean? That means that the trader can sell you, the lender of the limit order, can sell an asset at a predetermined price for 24 hours. So they have the right, but not the obligation, to sell somebody an asset at a predetermined price. If you pay a premium upfront for that, it basically becomes an option. This has, like a bunch of like really cool implications. Number one, you share liquidity between spot and options, and every options market in traditional finance relies on an underlying spot market to function, right? So it reduces liquidity fragmentation very significantly, and just enables a bunch of like new stuff. Essentially, I think that like it actually goes way beyond composability. I think that like DeFi is also where just some of the interesting innovation like and experimentation is happening that stopped essentially in the 1980s in traditional finance, right? So yeah, that's kind of my 2 cents on the entire thing.
Do you have a take?
Additional take?
Yeah. Has he mentioned you?
Yeah, I mean, we share, all of us, we know each other very well. That's why he doesn't know my name now, because he knows my real name. That's the problem. As I said, we share kind of the same view from different angles, so I totally agree, totally like. He was digging into even more complex stuff that are, it would be, I mean, maybe we can dig into that, but again, I agree. We need to bring money in, at the same time we need to increase efficiency and make this thing really something new. We need to also avoid keep on wasting resources we have on chain sometimes. Darren started from interest rates. Actually, I think it's the most interesting stuff that happened this year. Like we had huge interest rate environments in DeFi, huge, like incredible. There was some protocols, okay, let's say, that allows to, sell interest rates derivatives basically under the hood, monetizing points market. So you couple together proof of stake, points market, restaking, all the stuff, and we ended up with like huge amount of liquidity, sitting there idle, getting huge interest rate, and all the rest kicked out of the market, So that's also an interesting stuff we can maybe dig into if Darren likes. Like, what's the impact of these things on the builders and on the ecosystem? Which actually is negative. That's why we think proof of stake is good, and we can improve it. But yeah, maybe Darren, we dig into interest rates.
Yeah.
Well, I mean, even before interest rates, you guys were all kind of talking about liquidity, right? Liquidity flowing through a few high things, right? So if we talk about like what's got TVL this year, there's really 3 things. One, the Athena trade, which is effectively a hedge fund with zero cost capital, but it's repackaged as a stable coin. You have LRTs, and LRTs wrapped with Pindle bonds, effectively. And those are the 3 things that actually sucked up all the liquidity. But it's also because you have kind of a bit of a herd mentality, and also you lack sophistication for composability of liquidity. So one of the things that we notice also with Ipor derivatives is there's a very high barrier to entry, very similar to, actually probably a much higher barrier to entry into interest rate derivatives or interest rate swaps or stake rate swaps than there is to futures. So we spent a lot of time thinking about a couple of things that we wanted to optimize on our own stack. One was the asset management component. So for example, if you deposit, let's say USDC in the pool, it becomes IPUSDC, which is your interest-bearing token. That's holding, that's underwriting a portfolio of derivatives, both pay and receive fixed against the traders. And then it's also simultaneously going out to the money market to yield. So you effectively get 3 different income sources. You get money market yield from over-collateralized markets like Gauvadan Compound. So that's your fundamental base. You get trading fees, and you get the net P&L. So it's really composing an efficient financial instrument, and this becomes like your idea of a decentralized bank with its balance sheet active in multiple places. And then I talked a little bit about like the composable structured products, where you take in, let's say in one smart contract call, you can take multiple calls on chain to create this structured product. And so we looked at this and said, okay, so first of all, the sophistication level is extremely high. And then the end user wants that kind of abstracted. So for Athena, you get this decentralized stablecoin. Or maybe not decentralized, you get this interest-bearing stablecoin. So we built a protocol called Ipor Fusion. We just launched it, I think about 3 weeks ago on Arbitrum first. We'll be launching it on Ethereum and then other chains in the future, in the very near future. I won't say which ones. But the whole idea is like this. The end user, they want a very simple experience. They want to put $1 or €1 or an ETH in the machine, and that magically finds the best yield. And this is a market efficiency engine, right? So for example, we had one pool, we had the pool that's live, which is the USDC pool on Arbitrum, and it was always floating the money between the highest yielding market. So it was going between Gearbox and Fluid and Gearbox and Fluid. But at some point, it deposited, I think like 60-40 between the two markets, and it brought both effective rates down to 6.22%. And this was a really cool mechanism because it was distributing liquidity optimally. So it's effectively moving capital to the highest return, right? So this efficiency mechanism, which is an off-chain calculation, I won't get into the details, but the structure, the smart contract structure of Fusion allows for off-chain automation while not sacrificing security and having it being transparent on-chain. You can have basically that dollar experience where you put it in the machine, it always finds the best yield. And by finding the best yield, it actually deploys capital where it's most needed. So it's not just actually going out to the over-collateralized money markets. There's all kinds of trades that you can construct on Ipor Fusion. Or maybe not you construct, maybe you're a passive depositor, but you get a risk curator or an experienced asset manager that constructs their strategy on chain. Maybe they're actually coordinating, the spot perps basis trade. Or there's a way to get a synthetic short through leveraged looping. And someone can construct this trade and they can open the vault to depositors and they can contract AUM. So the passive depositor, they get a strategy curated by a top risk manager. The risk manager gets access to capital, and the integrated protocol gets access to the capital inside of the vault. And so this is a really efficient mechanism to actually deploy capital where it's most needed. And this is something that I think that we're very much needing in DeFi. And I think if we look at kind of the herd mentality where all the assets are going here, all the assets are going there, we need a more efficient automation and arbitrage machine that actually deploys capital along the highest yield. And this is one thing where actually a passive person can get involved in extremely complex strategies by abstracting the complexity. It just becomes a one-click button depositing into a vault, but you get access to these complex strategies and also the yield generated from that.
Wow.
If I can add a couple of stuff, and here you see clearly the example, like he hinted at Pendle. So let's take Pendle as an example. Some months ago, you say you want to long ETH, old ETH, you could go there, take some additional risk, but basically have Renzo ETH yielding 60% per year APY. Fine, you sit it there, okay, fine, all the other protocols die. But imagine a future where I take the money, I put into a GMX Vault, V2 Vault, and I create a derivative markets on top of that. And maybe on top of that, Dan or someone else could build options. All the stuff like compounding all together. Obviously, you have to manage the stuff, but that's is the liquidity risk-taking narrative, basically, that we just invented now on this part.
Do you have a response then?
Yeah, I think composability is awesome, but there is a risk associated to it. So even the way we build it now, we put composability first and everything. We talk about structured product and so on, but always keep in mind that when you build a Lego system, if the first piece of the Lego collapses, everything else collapses massively. So this is something that we always need to keep in mind. It's composability is awesome, but it creates a lot of additional risk on top of it. And LRT that everyone was talking about, to be fair, I don't even know what that is at this point because I don't think no one actually really built it. Is there any actually product on top of it? Probably not. It's just people putting money, as Mathieu said, you put Ethereum here and then this Ethereum is going to Renzo it and you use your Renzo it on top of Pendle and then you use it up. But when you look back, there is nothing on the first layer. It's it's not a real economy, at least now. They have still to build it. So let's keep in mind, the concept of composability to me is like we need to make a line at some point on like how much you want to compose and for what. Because like building like, for example, what Smiley or InfinityPools are building is awesome. Like you're building on top of the strongest protocol as of today, which is Uniswap, or like, even if it's not Uniswap per se, it's like, the concept of AMMs for swap and so on, it is a very strong one. There's a massive liquidity. You build on top of a structured product, or you build, options, whatever, that's a very good thing. But like, the composability aspect out of it, we need really to make sure that it is well done. And recently, we haven't seen many hacks or exploit, I would say, but like if you remember a couple of years ago, like every week we have massive exploit, and when you exploit a project and there is something on top and something on top and something on top, you collapse an entire industry. And that, to me, is something that we need to keep in mind, especially if we want to get more like, into, again, like institutionals and so on. It is a due diligence that they're gonna do, like how many layers of risk there are associated to it.
Wow, layers of risk, how about that? I don't know about you guys, but I'm really liking what I'm hearing in terms of innovation and your thoughts on it, because like you said, Dan, it's a house of cards. So if one thing collapses, everything on top will naturally follow and collapse as well. So let's get Matt's take on this. What do you think could be a potential solution, or what would you like to see change so that the industry becomes more stable in a way?
Yeah, I mean that's a tough question. We've already seen, I think, like a few hacks happen. So one of the interesting things that we've seen over the past few years is that most hacks, most exploits in DeFi specifically, just because I don't really deal outside of that right now, but have actually been due to Oracle exploits, or various flawed liquidation mechanisms. So for example, talking about House of Cards and, composability gone wrong. Euler, the lending protocol, got hacked for, I believe it was like 200 million. Yeah, like something crazy like that. Ended up like well, right? But for a moment there, a protocol that was built on top of them, Angle.money, which is a Euro stablecoin. They had a bunch of like their users TVL on the protocol, and so all of a sudden, like users that thought that they had exposure to like Euro had exposure to a protocol that got exploited. They actually ended up making money on that exploit, which is crazy. Just, I guess, good.
DJ luck.
Yeah, I know, right? House hedge. But yeah, so I guess if we're talking, potential solutions, and I'm obviously very biased here, so, take it with a grain of salt, but building Oracle-less, liquidation-less protocols is the way to go. Which is coincidentally what we do, but totally unbiased, totally unrelated. But yeah, once again, the number one source of exploits has been oracles. Getting rid of oracles seems like a good start.
That's a good answer. Do you have a take, Berachain?
Yeah, so security. Oh, I was told from the public that this is better. So now you can hear my voice way better, my handsome voice. So basically, so security is, DeFi, you have software, so security at the tech level. Then you have interdependency, connection, money legalness, so that's risk. Then you have finance, so maybe liquidity risk. So, if there is no liquidity, then the market does crazy stuff, and then that may break the system. So you have a lot of angle. On the software side, better devs for sure, although it's difficult. Also for us, we are the devs and we are not that good sometimes. For sure, there are things that protocols keep at the security level. You're always rushing, so on and so forth. You get for an audit, you say, okay, fine. But it's actually, like if you speak with Web2 guys thinking about security, they laugh because, we have like this kind of artisan environment where you get a very good auditor that somehow fix your stuff. There is not really like, okay, let's see all data vectors, let's think through the stuff, let's use more randomized invariant testing whatsoever, now more, actually. Then we have all the procedure. What happens? Actually, Pendle showed to have extremely good procedure in the recent hack that happened, not to Pendle actually, but they immediately intervened in a very short amount of time. They were ready there, you know, with an OPSEC, everything ready. So that's one thing for sure, it will happen a lot. I think also liquidity, maybe to take a different angle, totally agree on Oracle on the stuff. Liquidity may also be interesting. You know, if you have chain with more liquidity, then you have less slippage, less stuff happening. Also, when you build, you can build stuff differently. You know, I can maybe use a DEX as a point, as a reference point instead of using an Oracle, but maybe the DEX, you know, is too liquid or maybe becoming liquid, and so actually I want the Oracle, and so then I ended up using the Oracle and maybe checking the DEX if I have time in the code base, but maybe skip it. So having more liquidity on chain is also the point. I think beside allowing more innovation, it will also increase the security at the end of the day, at least from a financial slippage and, you know, financial movements unexpected and black swan perspective, at least.
That was a good answer. You had me at less leakage. Darren?
I mean, I'd like to add something about the risk and the composability. It's an extremely experimental space, right? So, you know, if you're getting involved, you have to do your own research, you have to understand your risks, you can also leverage other people's research. But for example, like on the Ipor DApp, we really believe in the transparency of the blockchain. So crazily, we have this immutable ledger and smart contracts that can contextualize everything that's going along the value chain. So for example, the name Ipor, it doesn't mean like I am poor. It derives its name from the LIBOR, which was the benchmark rate that was underpinning something like 300 trillion in debt deals and derivatives. It was actually wound down because crazily bankers were exploiting it for their own gain. I know this is shocking to all of you, but it's an extremely important tool. So we said, okay, so let's take something like the LIBOR, let's build the transparency that you can get on chain. So instead of asking self-reporting potentially corrupt bankers, the Ipor index references the smart contracts, which cannot lie because it has an immutable state. So we can actually get much better constructs of traditional finance on chain. And so if you look at the Ipor DApp, for example, if you go into the asset management feature, we built this screener that looks like something like, I don't know if you guys have ever been in a hybrid car, but you know, you have the gas engine, you have the electrical engine, and it shows where the money is flowing. So we built this screener, and you know, I described the balance sheet of the decentralized investment bank. You can see where the money goes in, where it's deposited, what the APR is. And all of this is not self-reported, it's just actually tapping into the ABI, or the application blockchain interface of the smart contracts themselves, so you can always know where's my money. So if you look at the blow-up of FTX and Alameda, which were effectively the same organization, which were doing suspect things with other people's funds, in the Ipor protocol, you can see where the money is in the machine. And this is quite nice, and I think like as an industry we should focus a lot more on transparency and the transparency that the blockchain gives us, because it's super fucking cool, sorry to use the word, but you have all of this transparency about what's happening on chain, you have this contextualization, you have the accounting on the blockchain itself, so you actually remove some of this trust element. Yes, smart contracts get hacked, yes, they get exploited, it's extremely experimental and potentially quite dangerous. So you should also think in risk-adjusted terms. But you know, like as protocols, we should give the end user all of the tools so that they can do their own research very easily. And that's really cool. Like embrace the transparency that you get on chain.
Embrace the transparency. This has been a really, really, really amazing conversation, if I do say so myself. Very dense. I feel like I learned a lot. Hope that you have as well. So I'll ask you one last question before we open the floor, and prepare your questions. Our speakers will have a couple minutes to answer them. What is one piece of advice, the key piece of advice that you would give someone who's interested in getting into derivatives? That could be something about mindset, that could be something about strategy. What would be the one thing that you would choose? Who would like to start?
Are we talking about from a builder, from a trader, from
a trader perspective?
From a trader perspective. Good question. Don't get liquidated. No, I would start by saying that first of all, understanding the instrument that you're using is quite critical. Understanding like how funding rates work, how like all that stuff works, like really being able to understand the mechanics of the instrument is quite important. So, read white papers, educate yourself. Don't go too degenerate, like start off slow, and then as you start making money and more money, then you can leverage up. But yeah, otherwise, have fun, really.
Nice. Great answer.
Yeah, so on my side, I'm not much of a trader, actually, although I said working in banking, study finance, still not my kind of job. But focusing on crypto, I'd say, specifically. The things that you shall do, like every time I meet someone, maybe older, younger, I don't know, asking about crypto, and like, okay, if you're really interested, bring your money on-chain. Never use a checks myself. Once Binance, but just to do off and on ramping. Bring the money on chain, so you learn what is a wallet, then you start using maybe a protocol, but to do that you have to learn a bit, you study, more, and you really get into what is the DeFi space and crypto, so on and so forth, because then you have your money there, maybe little, maybe much, depending on you. If you use Ipor, maybe you have more money, otherwise not, but still, bring the money on chain, use them, play around, and at worst you become a builder, because you study and you learn how to do it.
Great answer.
Yeah, I guess similar to what Mathieu said, is like probably first thing to understand is like what you're looking for, right? Like derivatives, you can have many things like interest rate, you can have options, you can have perps, you can have pretty much everything. So understand what is your goal. Like you want to make a speculation on direction, you want to make a speculation on volatility. Like the thing about derivatives, they are built to solve many different problems or needs, if we can call it that way. So it's like most of the time, like I remember especially on the first, when we were doing options, a lot of users coming to Discord and they were like, oh, I think Ethereum is gonna go up, what should I buy? And I'm like, think about the other way, like, there are many other things that you can trade. It's not just you can trade price going up or price going down. And that's kind of like the thing that when people should approach derivatives from a trading perspective should understand. It's like there is an entire world of things that you can trade that you don't even know they exist, from the interest rate, from volatility and everything. So probably like educate yourself on there is like a world of opportunities, find the one that's gonna fit your need, or like change your approach on the world that is not just market up and down. There is way more than that, and that's why derivatives are, a very interesting instrument. I learned like if you trade perps, you're gonna get liquidated, so better buy spot, right? At least you have lower risk. But again, like the reason for perps is you can buy way more spot with the same amount of money, which is getting like very appealing at this point. So again, like figure it out what is your need, and there is definitely a product that's gonna solve your need, and there is a world of opportunities which is not just market up and down.
So my one liquidation of the year was on Smiley Finance. Thank you, Bearlusconi. I got a little too bullish. ETH ETF.
I had to change job.
If you typical
Bearlusconi was the one that liquidated you. I saw him.
Typical trader getting started wants to get rich quick, and this mentality is going to get you rinsed over and over again. So start small, but put something on the line. So, for example, I'm a poker player by hobbyist, right? And whenever I'm playing with someone new, we sit down and say, okay, put $1, €1 on the table, because when you have some money at stake, it completely changes your mind. If you go, trading on a test net, if you go back testing, you have a completely different mentality than having any skin in the game. Start small, learn, invest a lot in education. I mean, basically, you know, we talked about the casino, we talked about the perps and the gambler's mentality. Like this, it's going to probably end bad for you. So back in the day, we were the #2 exchange to IMTGOX in 2011, and the market was tiny. Like all market cap of all Bitcoins in circulation was 10 million. We're like, we made it. Trading this range from $3, actually it's more like $32 down to $3, there were so few market makers that my friend described it, my business partner described it to me like this. He's like, imagine you're in the forest, there's a bunch of hunters, and they all have a shotgun. And then you send a little bunny through the forest. And if you're starting trading, you're the bunny. So understand that when you start, you're probably gonna get rinsed, you're probably gonna get liquidated, make some small mistakes, invest in self-education. Don't think you're gonna get rich quick, because if you think you're gonna get rich quick, you are the rabbit.
Wow.
Yeah.
That really brought the visual home.
Yeah, just wanted to say I actually completely agree with the skin in the game stuff. Like, in fact, the last 2 books I read were both on that. Like, one by Nassim Taleb that is literally called Skin in the Game, and that's essentially 300 pages of him just saying, yeah, like you need skin in the game. And the other one being Ed Thorpe, you know, a man for all markets, the man who beat blackjack, who beat the markets, who beat pretty much everything. And yeah. And yeah. I mean, a lot of people think Black-Scholes are the first ones to have, discovered the Black-Scholes equation. It wasn't. It was Ed Thorpe. Thank you, Dan, for reminding me.
Yeah, there is this blackjack player that he was counting cards and stuff, and then he realized that options are always mispriced. Because we're talking about 60s, 70s, that didn't even have like computer at the first place. And options is just a matter of pricing the probability of an event to happen, right, by a certain date. And so this guy was the first one to realize that they were all mispriced and actually figured out a way to price them. And then starting from there, Black-Scholes they made a formula and they made this more public. But Mathieu's right. To add on what Darren said, I can tell you the numbers from an exchange perspective. You know, we run an exchange, so we saw, and blockchain, like everything, there is transparency. So you see the first one winning and you see like the one losing. In our case, the first one winning, guess who is? The market maker. And it's making like something like 80% annualized. And most of the other retails, they are losing that. So keep in mind that there are people on the other side with very sophisticated models, very high frequency tools and so on. They will figure it out if there is something going wrong into the book and they take an opportunity out there. So what Darren said is extremely right.
Okay, we have time for one question. Who's got, yes, please, let me bring you over the mic.
It's not looking good for you, bro.
Yes, please, thank you.
Who's asking the question? All right.
So a lot of you talked about bringing institutional capital into the space. So I work at a large European bank. How do we get banks to use DeFi? Because for a bank, it's really hard to use even the largest DeFi protocols out there, the Uniswap, Aave. So like, what are you doing to bring true institutional capital into the space? Or do you think we're just not there yet? It's going to take some time.
I guess maybe I can start. I think that honestly, well, first of all, we're seeing large institutions slowly get into crypto trading in general, right? With like perps, right? So you have Citadel, Jump, like I guess Jump Crypto, et cetera, that like are already trading perps. Using DeFi is obviously the next step, but as it currently stands, I think that if we don't actually offer them something that they cannot do in traditional finance, they simply won't use DeFi, right? So what we need to do is essentially offer them something that is simply impossible to do in traditional finance, a use case that is 10x better in some regard, right? 10x more leverage, 100x more leverage, maybe, you know, different types of markets, different financial instruments that enable you to do something that was impossible before. Yeah, I'm a big Peter Thiel fan, so you know, competition is for losers. Just do something that they can't do.
So, tough questions, thanks. I know the guy, maybe. We are building a chain for that. And you will say, why, how Berachain is doing that? So, let's keep the legal stuff that are for the regulator, so I know nothing about, so I'll skip them. But let's focus, I'm a bank, I'm a big European bank, as you said. To invest €1 in technology takes 3 years, and actually I have to invest at minimum 10 million to do everything, otherwise no one cares. So I need DeFi and the crypto space to be liquid enough. That's my problem at the end of the day. Like, let's say the legal is fine, everything is fine. Still, I want to trade easily, easy money, 500 millions per day, you know, chips, peanuts, with no slippage, as we said before. So we need liquidity on chain. That's the problem that we are trying to solve, also for the institutional players. How we do that? Moving from proof of stake to proof of liquidity. So now we have all those idle assets there supporting the security of the chain. That's proof of stake. And the idea that we are trying to make it happen is that, okay, but can we use that for other stuff as well? Can we use those money as liquidity in the chain? Can we support with the chain function itself the liquidity of the protocol so that also institutional player can jump in, and then it becomes, you know, a self-fulfilling prophecy, because then obviously the banks trades a lot and brings also a lot of liquidity. So no, you know, we have this spiral, positive spiral. So that's what we are trying to achieve on that side. Let's see, fingers crossed, but pretty bullish.
Yeah, I really agree with Mathieu's approach. Like right now, unfortunately, DeFi has lower liquidity and no compliance. So it's very hard. Like, you know, they don't really have a big benefit out of it. On the compliance side, there are people working on it. I think we started to see the first solution where, you know, you can basically whitelist the type of users. You can, you know, KYC them, so only certain others. It's probably going against the ethos of crypto a little bit, but like I do understand that, you know, there is a reason and there is a potential. So as long as you don't force every user to do that, but only, you know, certain, or you create specific platform, I think it is a good thing. On the other side, I do think like institutional is a natural evolution of the space. When you start to have new type of products, you start to have like new primitives, you start to have like certain type of liquidity. I mean, my approach is very pragmatic. As soon as there's gonna be an opportunity for them to make money, they will figure out a way to get in. And as soon as there is an opportunity for onboard all those users, we'll figure it out from a tech perspective, from solutions, from compliance, a way to get them in. So I agree with Mathieu, like let's offer them something that they want to get as a product and they should flow. But as of now, we are extremely far away, I have to say. Like I spoke to many institutional, like especially the very big ones, because, you know, when you talk about small shops, it's kind of easy for them. Like, but even the big one, it's hard for them right now, especially from a compliance perspective to, you know, be a bank in Europe and know who's your counterparty on crypto. Just like, there is no way you can do it as of now.
Yeah, it won't happen until it does. And the number one thing is the regulatory barrier. And it's not something I think that, okay, so institutions are risk adverse by nature. Ethereum, for example, DeFi and Ethereum, it breaks all of the rules of compliance. All of us are pushing the boundaries. It doesn't break the rules of compliance by design, it breaks the rules of compliance by experimentation. Nobody started building DeFi to say, okay, so how can this DeFi protocol comply with AML rules, traditional AML rules? No one started building, like for example, if you are an LP on Uniswap, you deposit 2 different assets into a pool. That pool, by definition, are commingled funds. If you are running a trader or a brokerage account, you have to have segregated accounts per user. These 2 things don't match up, but it's not because, you know, Uniswap Labs said, you know, like, let's, like, we hate regulation, we hate like customer security. Say, from the Ethereum perspective, on the smart contract perspective, it doesn't make sense to have these segregated accounts because it's too expensive for gas. So they came up with a really fabulous mechanism to be able to bootstrap a market. And so the tech was never designed to deal with regulation. On the other side, the regulation cannot adapt to the technology, so we have to find a middle way. Until that middle way happens, it's never going to happen. banks also want to dominate the technology, but they're actually now much more experimenting with public chains, and this whole narrative of private chains from like 2017 on has really gone away, and you have a lot of people actually issuing assets, or at least the proofs of them, on the public chains. So it's not going to happen until it does, and you have to have a lot of kind of middle ground.
That was a great answer. It's not going to happen until it does, and that's all the time we have today. Please give it up for our speakers, Darren, Dan, Bearlusconi, and Mathieu. All righty. Thank you, everybody.